Zoom, zoom with the boom.
Zoom, zoom with the boom, boom. There you go. There it is.
Catchy. I would click that video.
What's happening, everybody? It's your boy, Chicago Sean McLaughlin. I'm the Chief Option Strategist at All Star Charts, and I'm joined today once again with our head technical analyst, our director of research, Steve Strazza. What's up?
What's up, dude? We zooming?
Dude, I found that video. I'm gonna hit you in Slack right now. It's a band called a group called Rex in Effect, Rump Shaker, and it's the song that goes with today's trade. So for the rest of you out there, Google it. Rex in Effect, Rump Shaker.
I feel like Sean definitely hung out in some mosh pits that would have made me uncomfortable back in like the 90s. Is that true?
Well, this group does not qualify for the mosh pits that you're talking about, but yes, that is indeed true. I hung out in a lot of crazy mosh pits in my younger days.
I'm going
All right.
Yeah.
So Strazza, thanks for filling in last second for JC. You're a better looking JC, so this is good. This works out really well.
Yeah. Happy to do it.
So, but it's actually, you know what, it makes sense that you're here because this trade that we're going to talk about today, the genesis of this trade actually happened yesterday, came out of our Follow the Flow report. The Flow show we were talking about yesterday. We were just kicking the tires on it yesterday. And the more I thought about it, the more I liked it. So the trade we like is Zoom. You got a chart up here on the screen right now. Why don't you tell me what you're looking at here? Let's set this up.
Listen, people don't love stocks like Zoom right now, right? This is a part of that long duration asset, super high growth trade, the ARK-y stuff. But this is a ratio chart of Zoom relative to ARK. And you saw that ramp up, obviously, in relative strength. This is when, Zoom was the stock that everybody wanted to own just about 2 years ago. You see on the left side of the chart. And then we came crashing down. Relative weakness was, just pervasive over the past year and a half. And now we've built out a nice bottom, took out some, shelf of key former lows, a price peak from 2019. And now it looks like this relative trend is reasserting itself. So if, God forbid, ARK and growth stocks ever, find their footing, this is one you definitely want to be in. It's actually a leader right now in a very weak space.
Well, before we get all excited about Zoom's outperformance versus ARK, let's also keep in mind that ARK has been getting destroyed. So it's a low bar, right?
Low bar, yes.
But that doesn't take away the fact that we like the chart set up in Zoom itself. Why don't you flip to the Zoom chart there? Here's what got me excited. And we started talking about this yesterday. We're going to continue the conversation today with this. Zoom, less than 2 years ago, if my math is correct, traded as high as just a scotch under 600. I believe the high was just under 600. And since then, the stock has just gotten absolutely murdered. And this is no secret. Everyone's been talking about this. The stock's been all over the news, all over the media. It got as low as sub $80 recently. So it went from 600 to 80. That, no matter how you slice it, is straight cold murder.
It's been rough.
Yeah. Now, the beauty of the trade that we're going to go through here is that we are not making the call that Zoom has put in a generational bottom here. Okay. That's not the call we're making. This stock very well could go lower, and it would not surprise me in the least. Okay. We could break this year's low. We could even break the all-time low. That would not surprise me at all. However, given the carnage that we've seen and the fact that, pretty significant level that you've got highlighted there in gray, that horizontal level that it was price memory going back to the IPO, basically, given that we're in that area now, if Zoom wants to bounce and put in some kind of tradable bounce, this seems like a logical level to do it. And I think the recent sell-off that we had was kind of like, could possibly be a good little bear fake out there, little fake out. And if Zoom wants to bounce from here, boy, there's a lot of room to bounce and still maintain that downtrend. I mean, this stock could go up to Strazza. I mean, I don't think it's crazy to say that this thing could go back test 200. And that certainly wouldn't put this in a bullish regime, but it would just be a nice big bounce off of this tremendous sell-off that we've seen. I mean, am I talking crazy here?
You're not. And I was literally just making a very similar point on our Inside Scoop weekly call, right? So something like Zoom, you always want to ask yourself, like, where have we come from? Stock's in a 90% drawdown. And hate to get all fundamental on you, but sometimes, when stocks are in a 90% drawdown, you got to throw on that fundamental hat. They're not going away. We use them every day.
We're using it right now.
We're on it right now. We use it every day. A lot of companies do. This is a very popular, tool. It's part of, a lot of people's tech stack at different, small businesses. Worst case scenario is these guys get acquired. So I don't think you want to bet on a zero. And when you see something 90% down, all right, like you said, we can very well undercut those lower lows. That's the environment that we're in. But I was looking at Coinbase as an example. Zoom, it's less extreme of an example because it's been so strong. But like Coinbase can triple right now and still not be at its 200-day moving average. That's the kind of carnage that's going on, right? So you were just talking about what, 100% bounce? Yeah, that's not crazy. Guess what? It's still a downtrend.
Yeah, no, we could print 200 tomorrow and we're still in the bigger picture, still in a downtrend in Zoom. So, hey, the trade that we're putting on is taking both of these scenarios under consideration. The continued sell-off, this is just like a little fake out bounce, and then we're going to go back and make lower lows. If that happens, fine. The trade we're going to put on, we're going to walk away unscathed. In fact, we're going to walk away with a little bit of a profit. Not the profit we're playing for, right, but a profit is better than a sharp stick in the eye. Right. Meanwhile, if the big bounce does happen, which would be totally within the realm of possibility, if that bounce happens, we've got a trade on that will potentially dramatically profit, at least given, relative to how much capital we're tying up here. So here's a P&L graph of the trade we're putting on. We are putting on a bullish ratio spread. Now, this is a spread that we don't do a lot of these, mostly because they're complicated. And Strazza, JC knows, our longtime subscribers know, we like to keep things simple around here. When you overcomplicate stuff, then you make mistakes, right? And I don't want to make mistakes. So we don't do a lot of these ratio spreads, but I felt like in this scenario, in this situation, it was warranted. And so what we are doing is we are with Zoom trading just a little below 110 right now. We are selling in August. We're doing the August option, so we have about 3 months to expiration. We are selling a 110 call and then taking those proceeds and using them to purchase two 130 calls. So for every one option that we sell at 110, we're buying two 130 calls. Okay. And the way I put it on, and I think it could still be put on at this very moment, is we put it on for a credit. I got $1.25 net credit for this trade. All right. So what that means is if Zoom goes lower and stays below 110 between now, or it doesn't even matter when, but at expiration in August, if Zoom is below 110, then both of these calls will expire worthless. We'll have nothing to do. And we walk away keeping that $1.25 credit that we collected when we first put the trade on. That's not the profit we're looking for, but hey, that's nice comfort knowing that if Zoom crashes, we're still going to profit.
You're telling me if the trade doesn't work the way we think it's going to work, we still make money. I hear that right?
Well, if Zoom goes down, we're bullish. So if it goes down, that means we're dead wrong, right? And if it goes down, we can still make money. Again, not the money we're looking for, but we'll take it. Okay. Now, that said, that's the bearish scenario. Now, there's two bullish scenarios. Let's talk about the good news first. If Zoom takes off, if it zooms, as we said, if this thing goes to 150, 170, 200, which again, totally within the realm of possibility. It's a long shot, but it could totally happen. You could see here, this orange line is what the P&L on this trade would be today. And so I can't show you the numbers here because it's not a live picture, but if we get up to say 150, let's say it happened next week, probably not going to happen. But if it did, we'd be sitting on probably $1,000, $1,500 in open profits per one lot, guys, per one lot. So tremendous upside potential if this stock takes off and takes off quickly. And I'm in the camp, Strazza, which by the way, I should have mentioned earlier. I'm in the camp that if Zoom is going to move in either direction, it's going to do it soon and it's going to do it fast. Okay. That's my opinion.
Yep.
I could be wrong.
That.
But that said, the worst case scenario here, which we're going to avoid the worst case. We got a lot of ways to do that. But the worst case scenario would be if Zoom just kind of meandered higher, took its sweet old time, went up like 10 cents a day for the next, 3 months. That would be the worst case scenario. And if we were still in this position on August expiration day, which is August 19th, you can see here, and the stock was at 130. So the stock has moved almost 20% in our favor, but we're at the 130. That would be the worst case scenario because of this short call, because we are unprotected all the way up to 130, which is where our long calls start kicking in. So the most this spread could be worth for us to buy it back, we would have to buy it back. The most it could be worth is $20, because that's the difference between the strikes, the 130 minus 110. So it costs us $20 or $2,000 per one lot to buy that back. And that would be total loss. But we're not going to let that happen, Strazza. The way we're going to manage risk, the worst case scenario is that Zoom goes up and it goes up slowly. So the way we're going to manage risk here in this trade is if we start going up, but we're going up slow and our position is losing money, then if I ever find myself down as much as the credit I received, so I brought in $1.25. So let's just say I have a one lot on, okay? So I collected $125 when I put this trade on today. If I find my open P&L in this trade to be down $125 or more at any point, that's going to be my signal to close the trade, Strazza, because that means it's moving up and it's moving up slowly and it doesn't have the speed that we need. And I'm going to take my loss at, when I'm down 125 or a little bit more. The nice thing about this trade is that losses won't happen fast. It'll be a slow drip. It'll be, a nickel and a dime every day of theta ticking away at you. So it's not like you're going to be up $500 one day and then the next day you find yourself down 1,000. That's not the type of trade we're going to have here. So if I'm down $1.25 in this trade or 125 per one lot, that's when I'll take the trade off. But otherwise, if Zoom is moving up and my position P&L is in the green, I'm going to keep holding that baby as long as I can because we could be in for a big ride.
So I think it's interesting here because basically we want Zoom above 130 for this trade to really work. You have pivot highs at 130. So I think good way to kind of figure out, where things are headed is we run back into those pivot highs and don't break through, sure, a little backing and filling there would make sense. But eventually we got to resolve back above and make a higher high here. That's going to tell you this trade's very likely going to pay you the way you want it to.
Now, for those of you out there who like the idea of this trade, but you don't like the idea of selling a naked or selling a call there, and that position, by the way, will require $2,000 of margin per short option that you have on. So if you sold just one call, it would require about $2,000 of margin. If that makes you uncomfortable, and for smaller accounts at night, you could have a similar P&L graph as ours if you just bought 130 call, right? But you're paying a little bit more for the premium. You have more maximum risk, okay? Because right now I'm looking at the options. They're quoted at about $6. So you'd pay $6 for a 130 call, and $6 is the most you can lose, okay? Now, the Zoom would have to crash quickly for you to lose that whole thing if you weren't managing your risk. But it costs you a little bit more up front, but at least it's a simpler trade. You'll participate on any big breakout, the same big breakout that we would participate on, but it'd be a little easier way for people to manage. But that's not the trade we're putting on. We're putting on the risk ratio, selling the 110 calls, buying 2 130 calls, trying to collect the credit for doing it.
Let me ask you something. Is there any scenario that could play out where you would take one call off first and manage risk that way?
See, that gets tricky, Strazza, because if I were to sell one of my long calls, if Zoom rips higher, right? And if I were to sell one of my long calls at one of my 130 calls, then that leaves me with basically a short call spread. And so now my position goes from being bullish to a bearish position. And I don't think I want to be bearish in a stock that's ripping higher.
Got it. So the only way something like that would work is if you had more than one of each, and then you would have to sell the equivalent amount or cover and sell.
Yeah, it gets tricky. It definitely gets tricky doing that. Not something I recommend. Remember when I said earlier, when we overcomplicate things, then we make mistakes, and I'm totally guilty of that. So,
well, this was fun for me because this is already overcomplicated. I've never heard of a ratio spread, so this is news to me.
Well, let me simplify for you the best I can. If you're in this trade, and let's say you did a one lot, right? So you're short one contract and you're long two. Cost you collected $125 approximately when you put the trade on. Okay. If at any point during your hold, your position P&L is down, you're down $125 or more, close it. You're out. Take the loss. It's totally small, totally manageable. You could live with that. If you're up, if you're green, just keep holding, baby. Just keep holding all the way into August and see what happens.
So in the losing scenario, really, you're getting out flat. Collected 125, and then you're closing at 120.
Well, if you're down 125, it'll actually cost you $250 to buy it back. So I'm legit saying your P&L would be at minus 125 or more. So at that point, it would cost you $250 or more to close the trade. But net, you'd be down 125. Does that make sense?
Yeah, let's go. Zoom's rallying. You're moving the market as you're talking about it.
All right. I think we got it. We took the long road, but we figured it out. I think Strazza understands. If Strazza understands it, I feel confident that the rest of you can figure this out too. But hey, hit me up on Twitter. Hit Strazza up on Twitter if you got questions. We're happy to answer it there. Brandon, we're all done, buddy. Pull the plug. We're out of here. See you, everybody.
Peace.